Hey, welcome back to Compounding Quietly. Most people comparing JEPI and JEPQ are asking the wrong question. It is not which one pays more. It is which one fits how you actually plan to use the income. Have you ever really sat with that question? Let's get into it. In the last couple of years, covered call ETFs became some of the most discussed income tools in the market, and that shift happened quickly. When traditional bonds were losing value during the rate hiking cycle, investors started looking for yield in new places. JEPI and JEPQ appeared right in that window, both offering monthly distributions, both from the same issuer, both carrying the word income in their full names. That positioning made the comparison almost automatic. Investors pulled up both tickers side by side, looked at the yield figures, and landed on what felt like an obvious question: which one is better? But that question already contains a hidden assumption. It assumes these two products are fundamentally the same type of thing, just operating at different performance levels. One pays a bit more, one is a bit safer, and the job is simply to figure out which trade-off makes sense for you. That framing is where most of the confusion starts. JEPI and JEPQ are not two versions of the same product, running at different intensity levels. They are built on structurally different equity bases. They respond differently to different market environments, and they serve meaningfully different purposes, depending on where you are in your financial plan. Comparing them by yield alone is like comparing two buildings by their height, without understanding what each one was designed to hold. You get a number, but you do not get the information you actually need. Most investors who get stuck in this comparison are not missing data. There is no shortage of information available about either product. They can find yield history, distribution records, expense ratios, and underlying holdings with a few clicks. The problem is not access to information. The problem is that the information is being evaluated through the wrong frame. When you approach a comparison looking for which product is quote-unquote better, you are already asking a question that neither product can answer for you. A product cannot tell you whether you need consistency or growth, potential, stability, or yield maximization. Only your plan can tell you that. Before this comparison can be answered usefully, you need to answer a more fundamental question first. What role is this income stream actually meant to play in your financial picture? Is it coverage income, meaning it needs to show up reliably to help offset real monthly expenses? Or is it enhancement income, a yield layer, sitting inside a larger portfolio that already has its own stability built in? That distinction changes the entire evaluation. JEPI is built on a portfolio of S&P 500 stocks, with a tilt toward lower volatility names within that index. The income generation mechanism relies primarily on equity-linked notes, a structured options vehicle, layered on top of that relatively defensive equity base. The design priority is clear: deliver consistent monthly income, while limiting the volatility that pure equity exposure would bring. In a flat or mildly declining market, JEPI tends to hold up reasonably well. The options premiums collected during periods of moderate market movement contribute steadily to the monthly distribution. An investor who relies on those distributions to cover a portion of real living expenses has something to plan around. Not certainty the distributions are variable, not fixed or guaranteed, but a structure that was built to support regular income needs over time. Think about a specific type of investor. Someone in the early years of retirement. They no longer receive a regular salary. They are not primarily trying to grow their portfolio. What they need is income that shows up monthly, that does not require them to liquidate shares to fund their daily life, and that does not swing wildly from one quarter to the next. For that investor, JEPI's lower volatility structure is not a compromise. It is a design match. The capped upside participation that comes with the options strategy is not a cost for someone who is not chasing growth. It is an acceptable exchange for the consistency the structure provides. JEPQ is built on a different foundation entirely. Its underlying equity exposure is concentrated in the NASDAQ 100, which is heavily weighted toward large-cap technology and growth companies. The same basic options overlay approach applies, but the underlying equity base is structurally more volatile than JEPI's broader, defensively tilted portfolio. That higher volatility has a specific effect in the options market. Greater implied volatility generates greater premium income. And those elevated premiums are the primary structural reason why JEPQ has historically offered a higher yield than JEPI. But the yield figure does not show you the complete picture. In a sustained technology sector, sell-off that hits Nasdaq-heavy portfolios, significantly harder than a broadly diversified index, JEPQ's underlying holdings absorb more of the drawdown. And this is exactly the moment where the product can feel confusing to investors, who were focused primarily on the income number. The monthly distributions might remain relatively elevated because that same market volatility is still generating options premium. But the price of the ETF itself can decline meaningfully over the same stretch. You might be collecting a high distribution yield, while the total value of your position is simultaneously eroding. That is not a malfunction. That is the structure operating exactly as designed. The underlying equity just moved into a cycle that was hard on technology-heavy portfolios. That is the nature of the exposure JEPQ carries. This brings us back to the original question. JEPI or JEPQ? The answer is not a single recommendation. It is a framework for deciding based on what you are actually building. If income reliability and protection from large drawdowns matter more to you than yield maximization, if the distributions need to function as real coverage income that you depend on, then JEPI's structure was built for that purpose. The lower yield is part of the trade-off for that consistency. If you already have income coverage addressed through other parts of your financial plan, and you are adding a yield enhancement layer inside a larger portfolio, and you genuinely understand that the Nasdaq 100 moves in cycles that can be painful, then JEPQ may be a reasonable fit for that role. But that decision should come from your overall financial architecture, not from which ticker has shown the stronger recent distribution. One more thing worth naming clearly: both products rely on options, strategies that behave differently across market regimes. In extended bull markets with low volatility, options. Premiums compress, which reduces the income both products generate. In high volatility environments, premiums expand, which can temporarily lift distributions, even in periods when the underlying equity is declining in value. What this means is that the yield figure you see at any given moment is a snapshot of current market conditions. It is not a forward projection. It is not a commitment the product has made about future income. It is the output of a specific strategy, operating in a specific market environment. Investors who hold these products without understanding this dynamic tend to get surprised when distributions shift. They see a reduction and interpret it as the product underperforming. But the strategy was not underperforming. The market moved into a regime that produced less premium, and the product responded exactly as designed. Judgment built on structural understanding can hold steady in that moment. Judgment anchored to a static yield number cannot. The comparison between JEPI and JEPQ is really a mirror for a deeper question. What does income actually mean to you in the context of your overall financial plan? If income means reliability, a stream that helps cover real costs with minimal surprises, you need a structure that prioritizes consistency over yield maximization. JEPI was built with that priority in mind. If income means return enhancement, a layer added on top of a portfolio that already carries its own foundation of stability, you have more latitude in what you choose. JEPQ can serve that role, provided you understand the cycles it moves through. Neither product is inherently superior. One may be significantly better suited for where you are right now. And knowing the difference between the two is not just a matter of reading data. It is a matter of knowing what you were trying to build in the first place. Long-term income investing is not about finding the highest yield. It is about finding the structure that fits your actual situation and holding it with enough clarity to stay calm when conditions shift. That kind of clarity does not come from comparing numbers on a screen. It comes from understanding what each structure was built to do and deciding which one was built for where you are. Compounding quietly investing that gives you peace of mind. If this video helped, subscribe and leave a like. I hope this becomes a small source of strength in your investment journey. The content in this video is for general informational purposes only. All final decisions and responsibilities remain with the investor. Thank you for spending time with Compounding Quietly today.